Thank you everyone for joining us today. We have a number of attendees who are joining us online, so a very big welcome to you also. My name is Sarah Logan and I'm a visiting fellow at the Africa program at the European Council on Foreign Relations. Today we are discussing a very important issue within the mining and mineral processing space: environmental, social and governance standards. ESG standards have grown in prominence over the last 10 to 15 years, particularly in industries such as mining that have historically had issues with environmental damage, social harm, some governance issues. And a range of actors from civil society, governments, responsible businesses and investors have really made progress over the last number of years, developing voluntary international frameworks, also improvements in the national legislation of both countries that host mining, but also the home jurisdictions of mining companies have improved their legislation over time. And the European Union has been a very strong proponent of responsible business and improved ESG standards, both within Europe, but also among European actors in their activities abroad. For example, there have been a number of sustainability-related disclosure and reporting requirements that have been introduced in the EU in recent years. But amid growing geopolitical tensions, Europe is facing a new challenge, notably the need to lower reliance on Chinese supply chains for critical minerals. Ways to do this, involve really diversifying sourcing for critical minerals, and this can involve either increasing mining activities within the EU or European companies going abroad to mineral-rich countries, including in Africa. But what implications does this new geopolitical situation have for ESG standards, and how are ESG standards either advancing or hindering Europe's progress in trying to secure critical mineral access? To discuss these questions and others, I have a great panel here of sector experts. We have Louis Marichal, who is a senior advisor for minerals and extractives at the OECD. Samuel Gahigi, who is the head of government relations for Africa region at Rio Tinto. Diana MacLeod, who is the Director General of the Cobalt Institute, and we will be joined by Jan Kloeter, who is Head of Government and International Relations, EU and APAC from Anglo American. Today's event is also in part to launch the most recent policy brief of the Africa program at ECFR. It's titled "Too Clean to Compete: Why Strict Standards Keep Europeans Out of Minerals in Africa." It's available on the ECFR website, and it draws on research that my co-author Theophilus and I have conducted late last year, early this year in Namibia and Zambia, really trying to unpack the role of ESG standards in European investments in mining and mineral processing activities. But before turning to the panel discussion, I just want to flag that we will be having a Q&A session at the end. We will have questions coming online and also, so if you're online, please ask the question on Zoom. If you're joining in person, please put your hands up and we'll have a microphone come around when we reach that. Now to my panelists, and I have a few questions for you just to get the conversation going, but please do feel free to raise any other points beyond the questions and also to contribute to what other panelists have said. So do feel free to make this into an interactive discussion. But Louis, I'm going to start off with you to get the conversation going. The EU has signed a number of strategic partnerships with African countries, so Namibia, Zambia, DRC and Rwanda on critical minerals and green hydrogen in the case of Namibia. To date, on the mining side, not many new European investments have materialized to date. To what extent and in what ways do you think ESG standards are a factor in contributing to European companies' reluctance to enter these value chains?
Thank you. Thank you for the invitation and thank you for the opportunity to comment on that topic, which is obviously very close to our hearts. Just wanted to get started by, unsurprisingly, again, highlighting the importance of ESG or responsible business conduct, as we prefer to call it in the OECD. And I think this is an important nuance because focusing on responsible business conduct is actually ultimately focusing on company management systems and their ability to identify risk and mitigate them, which in our vision, should help drive investments in those risky jurisdictions, which is something that I'll come back to. But so ESG and RBC is actually truly crucial to enable the industry at large to open up new mines, because as we all know, the social acceptance issue is really critical at the moment in this industry, and you can't really manage opening. I think it's several hundred mines that we need to open in the next 20, 30 years without ensuring that you have a degree of accountability, integrity, and responsibility. To your question, I think this goes well beyond just the European Commission, European institution, or member states. In Europe, in general, mining is vastly unpopular. There's a number of reasons for that. There's a legacy issue. We have a history with but I think above all, and something that's often overlooked and underestimated, is 10 years ago, there was a lot of miscommunication around the transition. And there was this perception, in particular in Europe, that the energy transition meant no extractives, end of the extractive industry. And now we're trying to sort of coming back on that narrative, telling everyone, well, actually, no, 10 years ago, we didn't tell you, but in order to mine. And going against this commonly accepted understanding in the public opinion that the future is all about energy transition, dematerialization, and almost absence of extractive industry is extremely difficult. And it's not just it's obviously the entire European ecosystem. And I think that's probably what's more important at the moment. And we're involved in a number of conversations around this, is how do you actually mainstream finance into mineral supply chains and into mining activities? And it's very clear from a number of conversations that it's in particular challenging in the European context to convince institutional investors and financiers to put their money into those high-risk activities. It's not true in other parts of the world. It's not true in North America. It's not true in the Gulf, in particular in Asia. And again, 2 weeks ago, I was in very interesting meetings with the financing sector and financing players. We're just saying we need to get the capital where it's sitting, and at the moment, it's in particular sitting in the Gulf, where they're able to articulate their strategic interests in a way that also meets some of the expectations and ambition of the financing players, the financiers. So that's broader than just, again, the Commission, the EU regulation, and ESG expectations. The big gap to fill a lot of communication and a lot of education that needs to. The other point that I really, and just concluding on that, in order to get those financiers on board, you need to say quickly credentials. You need to demonstrate that whatever mining activities they're going to support, those mining activities will deliver an impact and will mitigate environmental risks and social risks. That's why I'm really happy to be a commissioner on the Global Investment Commission for Mining 2030, which brings together a lot of institutional investors currently working on developing an investment framework. And they represent at the moment $17 trillion of asset under management. So obviously that's not all going in mining, but that's a big pool of potential financing that needs to be taken into consideration. The second point is the fact that it's not just, we're not talking about just miners. We're talking about, and it's going to, just said, European off-takers. I mean, it does not necessarily need to be European miners to serve the need of the European industry. It could be miners from anywhere, but supported by European finance and, more importantly, secured by European offtakes. And that's still missing for a number of reasons, but one of them being the fact that a number of European companies are extremely risk averse and will not consider sourcing from high-risk jurisdiction. And we've seen this time and again. This is what we call the de-risking strategy from companies across the world, and in particular in Europe. And that, again, does not necessarily have to do with the strategic partnerships, how they were signed, how they're framed. It really has to do with the fact that a number of European players in general have lost sight of what it means to invest and operate in high-risk jurisdiction. And finally, just to conclude on that, I think the main issue, and again, connected to the de-risking discussion, the approach of the OECD is always to say, in order to drive change and impact, you need to be around the table, you need to invest. The approach that we're hearing from a number of players, again, primarily in Europe, but not just in Europe, is show me that everything's perfect. And once you have done that, we'll put money in. That does not resonate in particular with African countries and their stakeholders. And that does not work for the mining sector in general. And that does not help with driving any sort of impact or change. So it's almost a state of mind / philosophical question that we all need to address. We need to get back to the basics, talking from an OECD perspective, basics of the OECD instrument, which is make sure that the most severe harms and risks are addressed and they're identified in our instrument, and build from there and engage. And yes, it involves some risk taking, but you will not be able to achieve anything if you're not willing to take some form of risk. And when I'm talking about risk, that involves a reputational risk. So yeah, just to conclude on that point, the notion of progressive improvement, leverage, driving change through active participation and engagement, that's all kind of missing in the current conversation in the EU. I mean, obviously in the EU in general, again, not focusing on the European Commission. We're trying to, be an active part in that conversation through our engagements, through our forum that takes place every year, and then last one was in early May. But again, it's mostly about a state of mind and an appetite for becoming a natural part of the conversation, as opposed to sitting on the side, watching and waiting to see when everything gets perfect and then potentially considering investment.
Great, thank you very much, Louis. Maybe just turning to you, Samuel, with your experience at Rio Tinto, and just to understand how ESG plays into risk management and decision-making within the company. How does it affect decisions, and has it ever played a sort of determining factor in whether a decision to invest was made or not?
Thank you, Sarah, and thanks for having me here in this conversation. I read with very great interest the policy brief. To respond to your answer, first, I would like to maybe narrow my my points to the Africa region, which I know best, and saying that as a company being the second major mining company, of course, ESG is front and center in the management, and we also have regular. I'll take the example later of the project we have in Guinea, which I know best because I was for about 1.5 years head of country there for Rio Tinto, the Simandou project. Now, let me make a couple of observations. The first one I would like to make is that drawing from the brief is that we definitely I don't think that we can consider that African nations are not sensitive to the need to upscale the ESG standards. I think in the first place that's what we see. It's important also for their ability to move to industrial mining. It comes with a number of prerequisites, and ESG I think is quite important. So and it's something that comes quite clearly in the report. Now we'll discuss really after that how we can eventually make some recommendations. So I think it's important to make that point, because sometimes we have a sense that the standards are actually on the one part of the world and not in the developing world and the global south. But at the same time, we also need to acknowledge that many countries, many jurisdictions in Africa consider that it's high time to unlock their mining potential, and definitely it's a race against the clock to make sure that they have an access to markets with the product. So how do we partner in that context? In Guinea, Rio Tinto is actually engaged in a joint venture with the government of Guinea in the first place, but also with Chinese industrial partners, including Shinalco, Bao Steel, and also winning consortium Simandou, which is a Singapore-based consortium, to develop the Simandou project. So Simandou is an untapped iron ore project that has the capacity to bring to market by 2030 at the latest about 120 million tons a year of iron ore, which is high grade, because if we look at the potential, the percentage of iron ore is almost 66%. So which means that if we look at when it gets through to market for normal processing of steel, you have about 2 tons, I think, for iron ore.
Iron ore.
Yeah, sorry. Sorry, it's my pronunciation maybe. So basically, it's part of the decarbonization strategy of Rio Tinto, because to produce with the quality of the iron ore that is in Simandou, you would reduce by basically to bring it requires production of 1 ton of steel makes it 2 tons of carbon. With the one of Simandou, it would bring it to 0.5. So which means that it's quite important for the decarbonization of the steel making globally. And steel making contributes to 8% of the global emissions. So it means that it's important also to focus on this. Now, to the project now, what we have implemented in terms of ESG standards on the Simandou project. We worked on the IFC, International Finance Corporation, ESG standards. Why? Because they are basically built on the SDG, Sustainable Development Goals of the United Nations, and their objective is to look at how to minimize the impact of those projects on environment and also on communities. So the work of our teams on the ground for this project that's going to complete in the next few months, and just to clarify, I forgot to mention that project involves the building of 670 kilometers of rail that cross from the Région Guinée Forestière, where the mines, the mining blocks are, up to the Atlantic Ocean. So the mine and also port facilities on the coastal side of the ocean, with significant and potential risks for the environment and for the community. So the work has been basically to co-design the measures, the corrective measures that could be eventually implemented by the companies, and co-design. And then we also relied on environmental and social impact assessments, ESIAs, that were actually conducted with local communities, but also with the government. So I think that's one way also of making sure that you have proper indicators that have to be followed and reported on. I think it's those ESIAs and those co-design strategies that are now used, and standards that are now used by the companies to monitor and report regularly, including actually to our there's a sustainable committee, SESCO, that reports directly to our AGM in the company that actually serves as basically the conduit where those discussions are taking place and presentations are made regularly to assess the impact of the project. So I'm just giving you this example to demonstrate that when we build a partnership with a government and with other partners, and we rely basically primarily on the risks that are identified collectively with the communities. And on top of that, we have also put some resources to mitigate the impact on communities. It's about 6.5 million, I think, that were invested last year to help basically those communities. When we do this, I think we definitely kind of de-risk the project, de-risk our investment, and make sure that we can still operate in high risky environment, as Louis was saying. So it's only just to highlight that example to show that it's possible to have those partnerships in place. And I'll what's important is to also have some transparent assessment and open consideration. And in Guinea, for example, at the moment, there is we have put in place a grievance mechanism with civil society organizations, CSOs, local CSOs, and regularly every quarter we sit together with them and we really review all those grievances that come from the communities and see how actually they can be corrected collectively, including with our other industrial partners that I've mentioned. The last point I would like to make here that when we look, maybe one suggestion I would like to make when we because I saw that there was a call for pragmatism. I think the best form of pragmatism for me would be to really see how to build a real partnership, because it's a one thing to rely on to prioritize reporting. It's another thing to see how can we basically help gradually change the realities on the ground with the government and the communities. I was in Zambia recently, and we had a discussion with the World Bank, and the World Bank came up with the energy transition mineral roadmaps that have supported the government of Zambia to develop. And in my view, looking at how basically they can help the government scale up its production by making sure that they support not only the mapping of the resources, but also upskilling the workforce, and also looking for renewable and alternative and clean energy sources to basically produce those resources. This is probably the way that we can and addressing also the ESG standards at the source. Probably those type of partnership of supporting the government could be one way of making sure that down the road, I mean, we reach a common objective of helping those countries unlock the potential. Time the standard help access the market, as the off-taker we were saying. Thank you.
Thank you so much, Sam. And welcome, Jan. I'm going to put you on the by coming now. So, you know, I've come across a few good examples of Anglo-American having really exceeded expectations on ESG efforts, mainly to mitigate the impact of mining operations on local communities. And, you know, taking this approach must incur additional costs for the company. So I'd be interested to just understand from your perspective how those costs are justified, what benefits the company receives in exchange for taking this approach. And also in the context of competitiveness and these potential additional costs, how does Anglo think about this, particularly compared to other companies, maybe from jurisdictions that don't have to adhere to high ESG standards? So aspects around, competitiveness and how you handle these costs in your approach.
I think, yes, that works. Hi, and sorry for being late, but I had let you know it's train and traffic. So. And sorry, I obviously missed what was being discussed before, but I'll just try and answer or get to your question without hopefully repeating too much of what has been said already. I mean, if you think about it in a cost way, yes, of course, there are costs in order to implement an ESG agenda and to actually bring about a responsible mining project. It takes time. And that is because you have meaningful engagement with the community, which by some is seen as a cost and possibly a delay of a project. Having said that, if you do it at an early stage, your cost is actually much lower than having to spend a lot of time or having a project delay once you've already invested a lot, and hence the impact on your MPV is a different one as well. It takes people. I mean, it's not only time per se, but it's also people's time, management time to have those engagements and to do the work. But again, if you compare that cost upfront to a potential cost that may occur once your operations are running and then they're suddenly not running anymore and you're in crisis mode, you spend a lot more probably high level management time on addressing that. And of course, the implementation of an ESG agenda itself, the measures you take, whether it is, I don't know, dust control, noise, any sort of social environmental impacts, that does cost money. Having said that, if you design it in the right way from the beginning, it will cost you a lot less than having to retrofit it, right? So there is a good case for doing these things in the beginning. And I don't know, I take a bit of an issue with this ESG compliance word that you said, because a lot of, I mean, we have to be compliant legally, otherwise we can't operate, we don't get our permits, and that's the same for everybody, every company, or you get fined, which many companies do. But it's basically actually enabling your operations to work, right? And that is on top of what is legally compliant. So the other thing is that these ESG factors can actually help you to improve your mine or your design by taking into account through local consultations. Nobody knows the area better than the local community, and through the meaningful engagement, you quite often get access to information that you possibly would not have had otherwise, and that helps you to run your operations in a way that it actually is in the long term more sustainable. So these factors are very often just very local. The local community probably, when we think ESG, very often we think carbon footprint, etc. But that's actually not so much what the local community will care about. It's a global issue, and it's a very serious issue, and of course we all do take it very seriously, but they care a lot more about the local impacts. I don't know, access to water, noise, dust, pollution, et cetera, et cetera. We often think about this in terms of, as I just heard Sam saying, the reporting, the ESG reporting side of things, but that's because we sit here in Brussels, whereas the projects are actually taking place on the ground. A couple of years ago, I think it was Ro from ICMM who said ESG in the local context actually means eat, sleep, go to bed, or go home, right? It's not about lofty carbon targets or other things. When it comes to the way the local community actually sees ESG or the ESG performance of a project, because the needs are very different. The other thing I think that is worth mentioning in that context, it's that the host countries, if we're talking about Africa, Latin America, etc., often they're not looking at a mining asset as an asset in isolation, but it actually is part of an industrial and local economic development opportunity, which means with it comes enabling infrastructure. So it's not we're not only looking at a mine, but we're looking at the access to power. We're looking at hard infrastructure, soft infrastructure in terms of health, in terms of education, etc. That comes along with such a project that we all need to have in mind when we actually go into a country building that, and that's part of our risk management, because otherwise a mine is not going to exist, just like Sam also said, right? Like if you just had the mine, you wouldn't get the ore out. So you build rail infrastructure, which is probably not only going to be used for transporting that ore, but it actually has local economic value in terms of transporting people, other goods, etc., etc. Coming back to your compliance piece, and I was just listening to the standards that Sam was alluding to. There's a lot of talk about voluntary standards, right? There's the Consolidated Mining Standard Initiative out there. There's other standards, RJC, Responsible Jewelry Council, IRMA is out there, etc., etc. And we that very value engagement, actually work with these standards. As a company, we've made a commitment in all our operations assessed against by a third party, by an independent third party, against responsible and reputable mining standards. We didn't specify which ones, and we take a rather pragmatic approach to which ones we actually use. We've done some operations against the copper mark. We've done operations in particular in Zimbabwe and South Africa, Brazil, against the IRMA standard. We've done TSM in Australia and in Finland. But again, on this compliance point, this is not compliance, right? Those are voluntary standards that go above and beyond what is legally required to be compliant and to be able to operate, to run your operations in a country. But what these standards actually allow you to do is to demonstrate transparently against an agreed and auditable set of standards and requirements to be transparent about your performance at site level. It's also the starting point for any sort of chain of custody going further down the value chain, which is what takes us into the competitiveness space, because that's where you can then ideally claim a commercial benefit, and whether that's a better price or I don't know, a green premium, or whether it is something where something I'd love to see more is public purchasing actually commits to using such products that actually have that kind of transparent site performance certification or assurance, because the public sector is a huge purchaser of construction, of vehicle fleets, et cetera, where all these metals actually go into. I'll leave it at that for the moment. But sorry, if I haven't addressed anything, just ask.
Thank you very much, Jan. And it leads very well into my question for you, Dinah, around I guess this green premium or willingness to purchase and to pay more for ESG compliant products. And just in terms of all of your interactions with cobalt users and different entities along the cobalt supply chain, have you found there to be an appetite for ESG compliant products? What, I guess, increased price do you think some users are willing to pay for it? Because a lot of this does come down to what could that green premium look like? And where do you see sentiment in this space around that premium going?
Great. Well, thank you very much. And first of all, good morning, and thank you for inviting me. It's great to be here. The Cobalt Institute is a trade organization with 60 members across the cobalt value chain. So we represent miners, one or two of whom are in the room, and as well as processors and end users of cobalt. So I speak half on for this answering this question. I think I'll speak to begin with. It's important to note that, first of all, I base my responses in my personal experience as someone working in development and sustainability for 25 plus years, and also that my comments kind of are limited to cobalt and largely the DRC as well, which is where we have most experience, where 71% of the world's cobalt comes from. And it's also based on my subjective experience of the EU while in this role. So I think you're supposed to have 5 talking points, and Benjamin Franklin says you're supposed to have 5 talking points. So I'll start with answering the question, and then I'm going to noodle through 4 other areas. The first of all, and again, this is based on my experience. I worked before joining Cobalt Institute. I was head of the Global Cement and Concrete Association, and I've worked in kind of business and sustainability for a long time. And I would say that the premium that I have seen most customers willing to pay for ESG compliance is nothing. Basically, and I also, as I go to the supermarket and I look at the labels and I look at my fish and I wanted to see the MSC standards, sure, before I purchase it, but will I pay €3 more? Will I? Hell, I'm sorry. It's even though it's my job and I believe in it. So it's important to say that that's, cynically speaking, I think that it's really hard to get people to pay a single cent more, especially if they're procuring for a building site, or if they're going to put cobalt into their automobiles or into their batteries. It's just usually price wins out. So I think I'd like to sort of say that you were saying, Sarah, that this is a foreign relations kind of audience, and it's important to know commercially that from my experience, ESG doesn't command much. What it does command, I suppose, is, and this is my second point out of 5, it does command, you have customers who are willing to buy from you or not. And the difference often is it's binary. You either have acceptable ESG standards or you don't. And so it behooves miners often to invest in these standards, because otherwise the most important companies, of which government, as you said, Jan, is such an important procurer, they want these standards, and therefore you have to do them. And it's the right thing to do if you're a right company as well, obviously. So I just wanted to sort of pick up on this idea of the importance of standards. And standards in our industry, there were some mentioned, the RGC, the IRMA. We could get into these, and in fact, we do enjoy a technical discussion about standards. But for this audience, I would just say there are many standards. There are too many standards. There is an industrial move towards making one common standard under which there is, so there's the ICMM standards and there's the IRMA standards, and it's all very confusing, and it's very contextualized, it's very context dependent, and it's quite frustrating, I would imagine, for some of our members who talk to us about, going on site in DRC and having 5 or 6 different standards that are coming in and visiting. So just to let you know, there's a lot of standards out there. They're quite confusing. It's quite frustrating for the industry. We know we need to do it because our best customers require it, and it's the right thing to do as a company. There also is, I would say, and I don't want to this is me just observing our members, but I think there is also something interesting for you to remember as you take away from this discussion, that there is a huge difference between standards at the mine sites and the standards that the OEMs, the users of the product actually have. And what your automobile manufacturer or your battery manufacturer wants in terms of standards is really very challenging to achieve. And there are fantastic standards at the mine site, for example, the copper mark, that are really, really very, very rigorous. And so there's also a tension between one end of my value chain members and the other end sometimes. So that's enough about standards, perhaps, although really we'd be very happy to talk more about it if you want to. I guess the third point I wanted to make, and it's a structural one that always underlines this, it's to do with a disconnect. There's a certain maybe unspoken assumption that if you want to buy ESG, I think you mentioned it, if you want to buy ESG, you have to be in one part of the world. So, Europe is great at this stuff and everywhere else is really bad at this stuff. And there's a real disconnect there because, there are a lot of organizations, a lot of companies out there, listed companies, not from the developed world, let's call it. So for example, one of my members is CMOC, which is a Chinese but listed company. It was the first mining entity to gain the copper mark standard in all of Africa. Closely followed, of course, by Glencore, is in the audience, who actually managed to beat their standard afterwards. But it's really important to remember that you have to look individually at each company rather than geopolitically when you're talking about ESG, because there are a lot of very good companies out there that are doing fantastic work and just do it because their customers require it, and also it's the right thing. So, and then I suppose the other thing I wanted to talk about, this is getting into point number 4, it's that this is all that we're talking about is not necessarily unique to the EU. I'm Canadian myself, and when you go visit there and visit, and a lot of pleading in the United States, what we are these incredible steps that are, 28 get a mine approved in the United States. So, we are not alone here in the EU. It's a worldwide problem. It's really important to remember that as well. And I suppose that it kind of bleeds into what is somewhat, I would say unique about the EU that I wanted to mention. And that is, in terms of foreign policy, it's important to remember, well, why do we want EU foreign policy on critical minerals? Because we need critical minerals to do stuff here in Europe. And so to do stuff here in Europe, that means processing and production. So one that I'd really like to impress upon this foreign policy audience, that there are sometimes incidences in which the EU right hand doesn't know what the EU left hand is doing. I've just done left and right wrong. Anyway, they get it backward. They get it. They realize that they need to do something about safety. And so they do these things on safety that actually mean that if they followed through, they would knock out the cobalt processing industry in Europe. And I'll give an example of that, and that's called the Occupational Exposure Limit, the OEL, which is a way of protecting workers from harmful effects of processing cobalt and other precious metals. Really important to have proper standards. There is right now in the EU decision-making system a move to make the OEL exposure limits for workers so low and not making anyone any more secure, making it so low that if you do if you do it, work on the economics of it, you realize that it would knock out, honestly, most of the cobalt processing industry in the European Union. So Cobalt Institute spends a lot of time saying to, foreign policymakers and policymakers, did you know about this occupational exposure limit, which if we go through with this, it's going to knock out our industries here. So I just wanted to make that, what's unique in the EU is the tendency to try to shoot itself in the foot on certain policy issues that will do no one any good, make no one any safer, and it will require no critical minerals to come into the EU if there's no processing industry to support it here. So I wanted to just say that from my point of view, the EU really it must become more transparent across what the different departments. I guess finally, the fifth point would be just to sort of riff on some of the amazing things that I've heard here today. Louis, I like the idea of your talk about investment in risky jurisdictions, and I just want to underline that. It's not necessarily ESG that's holding up investment. It's, in the capitals of the world where the capital is, there's just a kind of, that sounds really risky. DRC, they've got a war going on, haven't they? And so it's really a question of making sure that the investors are properly versed, who they actually know that there is an investment to be made. There's very good, there's a very good business case for investing in the DRC in our industry. But sometimes there's just a prejudice against it, and that needs to be worked on. The communication needs to be better. The other thing I wanted to pick up on was this idea of, the idea of Africa. It's, there's plenty of people who are super interested in ESG issues in Africa. There's plenty of governments who really, really want more ESG because it is good for their country. And I loved your paper where you were talking about the difference between CSR and ESG. A lot of African countries are interested in the CSR element, which is the investment in their community, which Jen, you were talking about. They want more investment in their communities, and they also want more value addition in their countries as well. They obviously want more business to stay rather than just the critical minerals leaving. So it's important to remember that as well. If EU wants to do more about ESG, how about helping develop African countries' ability to have more value addition within their own countries, which will help to do the S part of ESG and fulfill the mandate that the EU obviously has to ensure global development as well. I'll maybe leave it at that, but one last thing is to say that the government of the DRC is doing an amazing piece of work right now, which a lot of our member companies are involved with, which is to have a regulation of artisanal mining. So government regulation, safety standards, proper equipment on sites with a mining license issued to artisanal miners. And this is an absolute first anywhere in the whole wide world. And it should be supported. If you want to do more in ESG, have a look at that. Thanks.
Thank you so much. That is a lot of food for thought. And I wonder whether, just to come back to a central theme that's come up from all of you, is the issue around procurement and incentivizing changes in procurement, whether it's incentivizing European off-takers to commit to buying from new supply chains that also come from more risky environments, whether it's nudging towards purchasing more ESG-compliant products. Where do you see an intervention that could possibly work on shifting procurement? I know I didn't prepare any of you for this question, but it's something that we keep coming back to, is this issue of procurement really being the thing that needs to shift. and how we get that incentive to do that. Does anyone have anything you would like to start off a discussion on the procurement?
Oh, I'll just require it. Just require proper ESG standards and have a one that you like. Be standard literate when you're writing it up and say we want something that's Copper Mark approved or IRMA approved, and then just require it. After that, that's an incentive.
I'm not even sure if you want to specify the standard, because then you get in, it just becomes a boon fight for and as you said, there are so many out there. I think you rather specify the content and the requirements, and then you can follow into standard. But to your question, I mean, I've already said that leveraging the public sector. Because one of the challenges is at the moment that we don't have critical mass, right? And we don't, the level playing field is not there. I don't know what percentage the public sector procurement actually makes in terms of total purchase, but I'm sure it's a good 20-30%. If that part was to be responsibly sourced, you would have critical mass, and that could probably work then towards tipping over the overall market, or at least pushing it. The other thing, and I think we've seen that at least in some beginnings, is that upstream and downstream work jointly together. Ideally, the downstream co-investing in the upstream, right? Because so they have skin in the game, because that then helps them to understand the challenges that there are, get a better understanding, as you said, know the standards, right? Like what is it actually? How many audits does a site have to go through? Because it's not only those voluntary standards that have audits, you also have, I don't know, your ISO audits and God knows what. There's plenty of these audits coming to sites. But if they're actually financially invested in the upstream, it normally comes with an offtake agreement, et cetera. So you have a sort of a self-propelling loop, right? If you have stronger integration along the value chain.
Just a couple of thoughts. I'd like to get back to the incentivizing question and bring it down also to market access issues. And one key thing that we have not talked about yet is the work that the London Metal Exchange has done with its responsible sourcing requirements, which actually triggered the development of the Copper Mark and the joint due diligence standard that now goes into a number of supply chains. Quickly, if you want to be able to trade your metal as a producer and store it in an LME warehouse and have it traded on the LME, you need to demonstrate that you're implementing basic OECD requirements. That does not cover the entire ESG spectrum. That's an initial responsibility. But obviously, the industry in a number of ways. Therefore, it's interesting for brands around the world to be able to access that platform. And as a result, those mining companies which supply the materials to the LME metal manufacturers have to deliver and demonstrate that they're implementing some of the basic responsible sourcing requirements. So this market access issue, and it also works in the EU, and it also works to some extent in the US. It works, by the way, in the UAE on gold. This is increasingly getting implemented in a number of jurisdictions. So I think that's something that needs to be looked into. The other point that I wanted to come back on is leveraging public sector. There are many ways through which you can do that. And I think one that's not being investigated enough is, again, offtake. So how from the beginning, from the onset, you can manage to secure offtake by public institutions or delivering materials to industries that are of public interest, and thinking particular of the defense sector, how those offtake agreements can help develop mining projects, because securing offtake is a significant part of bringing costs down, the cost of finance for mining projects. That's what a lot of mining projects are looking for at the moment. In particular, projects in the EU that have been labeled strategic projects. So if we can find a way to ensure that through public offtake, you can service and you can supply materials to industries that are of sovereign interest for EU and EU member states, I think that would be a way of connecting public procurement and responsible mining projects. I think just looking at how public institutions can purchase products that entail components that it can entail materials that were sustainably produced is a bit more complicated at the moment, and that's less direct, less straightforward than offtake.
Great, thank you very much for that. We're going to move on to the Q&A session now. I'm going to just kick that off with a couple of questions from online participants while we also prepare to take some questions from the room. So a question from a colleague at ECFR joining online. China and Gulf countries' approach in Africa has been historically less constrained by ESG and backed by state-supported capital. Is Europe losing ground to these actors because they are playing by different rules? I guess just taking your company and various operations onto a higher level. Go ahead, Dan.
I can take this one because, as I mentioned, I think the Simandou project that is co-developed by Rio Tinto and industrial partners from China, including Baowu Steel, who's the lead steel maker globally, have demonstrated that, for example, this understanding on applying the IFC standards actually is really understood across all industrial partners involved in this project. I would add also that in that context, we have had some exchange of, for example, we have 2 blocks that are developed by Rio Tinto and Chinalco, and the other 2 blocks are developed by Winning Consortium and Baowu. But across those 2 blocks, the government's position is that we all are supposed to follow the same standards, and there's an alignment of those standards after the co-design I was mentioning earlier. What is happening is also that we have secondaries that we have placed within the other 2 blocks, and they have also placed secondaries on our part to make sure that this alignment is followed through. So I would say that the lessons we've drawn from this project up to now, and we are quite advanced in the development of the Simandou project, is that there's an eagerness also from our Chinese partners to actually operate within the standards that are co-designed and co-defined with a company like Rio Tinto.
Just very quickly, I think there's a misconception again, or a confusion about what we're talking about. ESG, responsible business conduct, is not only about taking a moral high ground. It's about managing operational risks from purely an operational perspective. And I think on that point, Chinese investors, Gulf investors, any kind of investor is facing the same kind of potential risks to the assets that anyone else anywhere around the world. So getting everyone to better understand what we're talking about, why we're expecting all those responsible business conduct requirements to be implemented, is also ultimately about ensuring that the asset can produce, can deliver. And it will be able to do that because local communities, local governments will be satisfied. And that is shaped through implementation of RBC recommendations. Just one concrete example, again, taking advantage from recent meetings, but Orion Resources, a big private equity fund, has just created an investment fund with a sovereign wealth fund from Abu Dhabi quite significant contribution of $1.3 billion. And they've made clear that all of the investment of that investment fund will have to meet ESG criteria of Orion Resources. So that's funds coming from the Gulf, but that will be dispersed following ESG frameworks developed by that private equity firm. So again, to your point, I think it's a bit binary and to some extent caricatural to believe that all the good players are in OECD countries, all the rogue players are outside. And I think we need to do away with that caricature.
Yeah, I would also say that maybe there is a bit of a historical perception that players from China and the Gulf may not have adhered to the ESG agenda. But from what we see, they're very pragmatic, and they very well understand that you need to follow these things, and that those are things that are simply expected to be done, and also they help you mitigate your risk of business continuity, etc. on the ground, right? So there. Maybe in the past there were different examples, but let's not kid ourselves. We have plenty of Western companies or global North companies that are not adhering to these standards either, or not applying them. So I don't think you can do a broad brush on this, and also Chinese companies have only been going outside of China for a couple of decades, right? Which means the operating environment that they were used to was a different one from the countries that they're then entering, and that brings challenges in terms of how business is actually being done, etc. And it's a learning curve as well, and it has been for us as well as a sector, right? There has been an evolution from, I don't know, a focus on safety, and then you add on and on and on, right? Taking a more comprehensive approach to ESG performance overall. And I mean, Dina, you said CMOC were the first ones in Africa to actually use the copper mark, right? Like, good example.
Thank you very much. We are also, seeing more and more Chinese banks co-investing in projects with non-Chinese banks and adhering to the standards that are set by others. So even just from the financing side, there has been a lot more alignment in terms of investment that we're seeing more and more. Maybe just to open to the room and questions, if we can take a couple and then we can put it to the panel.
Morning, thank you very much. My name is René van Rijssel. I'm a journalist working for the Dutch weekly EW. And I'm a simple question. Here it's stated in this paper that strict standards keep Europeans out of African minerals. But when I listen to you, I hear different conclusions. Can you maybe elaborate on that? Thank you.
Hi, thank you. My name is Guillaume Debrie. I work for EPIS. It's a real coincidence, but I'm just back from Guinea. I was there, I came back yesterday, and I want to jump on something that Louis Maréchal said. He said, and I'm summarizing in 10 seconds, but do we first have to bring the money and then talk about the ESGs that we have? Or first, do we want it perfect and then we bring the money? And I feel that Rio Tinto, you are in the Simandou, and so you are at the table. You have brought the money, and I don't in the room how if people understand, but Simandou is, as you said, it's a huge project. It's even Simandou 2040 is even the name of the political project of the General Doumbouya, who took power with a coup in 2021. So the entire economy is based on this nearly, and it's so it's the name of the political project of the new party there. When I went there and we were looking with CSOs to work on the unintended consequences of mining in the country, they said, we don't touch Simandou, we're too scared. The journalists are in jails, the CSOs are in jail, we don't touch Simandou. And to make it short, when they were talking to them, they said, our food security backbone is going to be destroyed because it's going to destroy pastoralism, it's going to destroy fishery. And so we don't talk about employment. But my point was, I want to turn that into a question, is how do you see your role as Rio Tinto, knowing that you can be actually, sorry for the word, manipulated by the governance. And as we were saying, you have ESGs, you have put the money on. How do you see your roles to actually make sure that you bring something positive with the Simandou, knowing that the local populations don't see anything more than a political move and the destructions of their food security. And that's a bit, I want also to jump on what Ms. MacLeod said for the Cobalt Institute is, we also believe in the CSOs that there are too many standards. The fact that we see is none of them works, and that's more where we have issues. You said many companies, they do a great job. It's possible in terms of standards and filling the standards, but our issue is more that we feel that those standards are more like ticking boxes. Because when you see, for example, the new contract that the Congolese government has signed with, I think it was with Sycomin, and I don't know if Sycomin is part of the Cobalt Institute, but what we see is the attendant fees are 20 million paid by Sycomin just to deal with a contract that if you read, even if you're not an expert, you see that it's a terrible contract. And so it's hard for us to hear that we have companies who do a great job and a tremendous job. So when we see that in the country, what's going to happen is in 5 to 10 years, Cobalt is disappearing. So, for example, Cobalt Institute, how much do you work with your companies to make sure that those ESGs are complied? Do you have a say on those? When you know those things that your members do wrong, do you expel them from the Cobalt Institute? Do you, what do you do with those knowledge? Thank you, with this information.
Great. Maybe we can take those to start off with, and then we'll come back to both in-person and online attendees for the next round. Very briefly on the heading, it's to get conversation going. There are very contradictory accounts as to what is holding back European investment. Some say ESG standards are a big hurdle. Others say complying with it makes them more competitive. There are very differing views on this topic. But I'm going to hand over to Sam and then Dinah on these very thought-provoking questions.
Thank you. And thanks for this questions, comments, observations. I think first, as you echoed, this project is huge. It's huge for Guinea. It's also huge for Rio Tinto in the sense that it's a high-risk jurisdiction in which an investment has been made. But as I said earlier, all steps have been taken to make sure that the risks are anticipated through the co-design I was referring to when it comes to the local communities, and also to investment into mitigating those risks and also monitoring them. As I mentioned, we have those regular consultations with the civil society organizations where and the grievance mechanism that were established at their request, including company like Publiez ce que vous payez and other NGOs locally. I was personally involved in talking to them regularly when I was in Guinea. But at the same time, like it's the case in many developing nations, I think expectations are also very high that this project should already start producing dividends before it's even running and in operations. So I think that's where the partnership with the government is important, because we develop the project, we're going to mine, and the government has to also manage those expectations and see that those dividends are transparently managed with the communities, with within the economy. I think steps are taken by the government also in that sense. And as you say, the Simandou 2040 strategy is quite interesting. It looks at how using the corridor of those 670 kilometers of rail to see how this can actually propel some different type of investments into agriculture, into micro infrastructure, into energy, because again, like many countries in Africa, Guinea also struggled with energy supply. So looking at how basically through this major investment, others can be tempted to co-invest and develop opportunities along the corridor. And as Jan was saying, it's a multi-user rail, it's a multi-user port. So I think it means that it won't be dedicated only to transporting iron ore. So I think it will generate also other opportunities for improving the livelihood of the communities. But definitely, we're also conscious of the fact that the immediate risks are important. And for example, there were some, on those grievances, some resources are invested to make sure that the impact on communities is managed. Now, there's what's related to our scope, which is the blocks I mentioned, and the scope of our partners. So when those incidents happen, there's also a dialogue that is happening, continuing, also with the arbitration of the state. But so far, all efforts are made to make sure that those risks and the consequences and impact are managed. I'm not saying that there's no incidents. That would be very ambitious to pretend that we can develop a project of that magnitude without incidents. But at least those consequences are taken into account and managed properly. The last point I would like to make is, while this project will generate by 2030 an influx of GDP that will increase by 50%, we're also looking at, as I said, CSR engagements, water sanitation, education, health centers in the vicinity of the mine and of the project. And last year, 6.5 million were invested there in that area. And we also have another portfolio that is called Regional Economic Development. And that's intended to really help local entrepreneurs and local communities develop alternative resource of revenues into agriculture. And for that, last year, 15 million up to now, $15 million were spent by Rio Tinto to support those activities. So I don't know if that answers your question or your concern. I would be happy also on the sidelines to continue that conversation and know exactly those concerns are. And definitely, again, we operate in a country that through has its own political timeline. But so far, I say that all those elements are captured in our context analysis of Guinea in the way the project is developed and implemented. Thank you.
Great, thanks. To the first question on whether ESG standards are hindering, I think I'd like to just point out that there are other things that are hindering more. Whether they are or not is maybe a discussion over coffee later. But there's just not enough finance going into the region, and that without that, there won't be there won't be enough flow between the EU and Africa. I think that finance, Louis, you talked about it, and I celebrate the idea that there's going to be more focus on this. We also are working on that at the Cobalt Institute, unlocking that finance. And there are several ways, not just throwing money at it, that we can do that. We can, so there are all sorts of tools and tricks that we can deploy so that there's a greater flow of finance. So I would just emphasize that. In terms of the discussion around standards, just to reiterate, the Cobalt Institute, the whole reason that we exist is to promote the safe and responsible use of cobalt across the value chain. That's what we're here for. We have a standard of conduct that all of our members sign up to when they join Cobalt Institute. And our whole, one of the most important functions that we do is to explore ways to develop knowledge and to disseminate knowledge and best practice about what constitutes good practice in terms of every aspect of responsible supply and processing of cobalt. And in fact, Louis and the OECD and Cobalt Institute work very closely together along with our members, and we have a constant dialogue on this. So what I would say is that our role is to facilitate greater information and to try to celebrate and to disseminate examples of very good practice. And to that end, I guess this is a great time for me to plug our Cobalt Market Report, which was just released. One of the things that we're most proud about is that what was it, 82% last year of refined cobalt was assessed in some way under the Responsible Minerals Initiative. So to me, that means that there's an uptake of interest and submitting business practices to these kind of third-party independent assessment mechanisms. And so if you think that their standards are not sufficient, then I suggest that you speak with them basically, and tell them to do more than ticking boxes. That's what the Cobalt Institute does. Is I know there are several standards where people come out of the assessment needing to take a holiday for a couple of weeks because they have really had a very, very thorough assessment. And I'm sure that they would welcome any improvement suggestions. Thanks.
Thank you very much. We actually are a little bit over time. So maybe I can finish with Jan's response, and then any further questions, please grab the panelists over coffee. I'm sorry that we weren't able to get to everyone, but over to you, Jan, for the last.
No, I also just wanted to to the first question. If we look at our global footprint and our revenue creator, it's 45% of that in the last year was from Africa. Roughly the same share, and another share came from Latin America, and then production. The revenue goes mostly towards the east for all of our all the major companies, at least the majority of that. And I totally agree. It's much more issues of governance, of infrastructure, access to power, access to transportation, etc. That make it a challenge. But I think we're all operating and or exploring. So I think it's a provocative title, right? To stimulate a conversation. On the standards, I'm really sometimes wondering what people actually expect from these standards, because if I look at us again, we don't operate according to an IRMA standard or to a copper mark standard. We have our own internal standards according to which we operate and according to which we have been operating for a long time, because many of these voluntary standards have only just emerged in recent years, right? It's not like what they are is they are a tool for verification of our site performance. right? And they sometimes they reinforce things that we already know, where we know we need to be better, and they make them transparent. But we don't operate according, and I can't imagine that Rio would operate according to these standards, right? Like, because Rio has its own operating standards as we do. I really sometimes think that these standards are being I can't find the right word, but yes, misinterpreted. And I mean, I even had this here in Brussels, where talking to an MEP a couple of years ago, and it was like, oh, we don't like this standard because they can veto mining projects, and you think, no, like that, there is a real lack of understanding of what they actually do. What you should also not forget, and this is our experience with IRMA, for example, is there is the standard that is sort of the hardware. But what has been very, very beneficial for us was actually the development of the standard, which took over 10 years. Where we've been sitting at the table between mining companies, downstream users, industry, union representatives, environmental NGOs, human rights NGOs, am I forgetting a house? Local community representatives, impacted communities, and you actually hammered out the standard. It took a really, really long time, but the reason why it's now relatively seen as a good responsible mining standard is because it has gone through that process, and that was very tough for everybody at the table. Us internally, we were being challenged. Why are you talking to these NGOs while they're campaigning against some project of ours? And I'm sure it was the same for some of the NGOs who, from their constituencies, were being challenged. Why are you talking to these mining companies about these things? But there was actually a joint goal to establish a responsible mining standard, and that journey has really helped in terms of mutually understanding what your approach is, how you actually work, what is possible, what is not possible, what makes sense, what doesn't make sense. But it took quite some time.
Thank you, Jan. We will leave it there for the panel, but the conversation to please continue, and extra questions over the coffee break. Thank you so much, and thank you everyone online for joining today too.